Good morning, good morning. Can we hear
Good
me?
morning.
Yeah, good morning. So happy weekend to everyone. Yeah, so we're going to start the class now. So today we'll be looking at, so in our last class, we look at the basis period, which we are able to end the aspect under basis period, where we look at what? Commencement, cessation, and what change of accounting days. So which are important aspects of our syllabus. So today we'll be moving to a new topic, which is capital allowance. So I believe we can see my screen, Abby. I have shared my screen. Can we see the screen?
Yes.
Okay, thank you very much. Yeah, so we are moving to capital allowance today. Capital allowance. What is the reason? So we need to look at what is the reason behind this capital allowance. Firstly, is that under our financial accounting, when we buy any asset, like when they buy non-current asset, they will say, okay, depreciate the asset or spread it, amortize it over some number of years, so that you can recover back the value, the money that you used in buying those assets or that you are using for business. The same thing is applicable to tax. Tax, instead of giving you depreciation, they now call it capital allowance. They will grant you what is called capital allowance. Because why are they giving capital allowance? One of the characteristics of a good tax is that there should be equity and fairness. Under one of the characteristics that we have equity, we have fairness. That means what you apply to taxpayer A must also be adopted to B, and so on and so forth. And you must also be fair to all category of taxpayer. No bias to any tax. But in the case of depreciation is usually based on company policy. It is the policy of the company that will give you a guide on what will be the amount of the depreciation that will be charged in any particular year. A particular company can say, okay, for their motor vehicle, they want to use 10%. That same motor vehicle, the company B can say they want to use 15% on the same category. That is not equity as far as tax is concerned. So this capital allowance now is a form of relief that is granted to any taxpayer who incur qualifying capital expenditure for the purpose of trade or business during a basis period in respect of of non-current assets at the end of the basis period. So when you are using a non-current asset for the purpose of your business, so those non-current assets you are using for the purpose of business will be available for capital allowance claim, which will be which you are going to use to reduce your tax liability. So in essence, this capital allowance is an allowance that replaces our depreciation that is usually granted under our financial accounting, because it's going to be granted at a uniform rate. If I'm buying motor vehicle as company A, the same rate to to allow for uniformity, the same rate will be adopted so that there will be uniformity in the application. The method of application is uniform and consistent to all tax. So the same way you compute for is also the same you are going to compute for B. Equal amount will be claimed. That's where provided that the asset acquire constants. If you are acquiring an asset, the same asset with the same value, you are going to be claimed on this rule apply to all taxpayers. So that's law. So those are the pictures. So, but before you can say you want to give somebody capital allowance, what are the conditions that will warrant you to be entitled to capital allowance claim? Conditions for granting capital allowance. Condition for granting capital allowance. One of them is that so expenditure must have been incurred on an asset. You must have spent money to acquire what? A non-current asset. You must have spent money to acquire a non-current, must have spent resources, in whatever form, to acquire what? The non-current asset. The asset must be a qualified capital expenditure. So as they call it QCE, assets that claim capital allowance are called qualifying capital assets. So that is the general name they call it called. We call it a qualifying capital asset, QCE. So that asset must be part of what? The asset that qualifies for capital allowance. The asset must be owned by the taxpayer making the claim. For you to say, okay, yeah, you want to claim capital allowance, you must be the owner of the asset. The asset, the ownership of the asset must not be, it must not be something that you rented, that you go and rent for the purpose of the business. Because after renting it, you are going to return it. So the owner of the asset will still what? It's also going to claim it for capital. So that means it will become double. So you must be the owner. The only situation whereby you may not be the owner yet and you be entitled to claim capital allowance on a bit by bit basis is what? When it's involved with hire purchase agreements. Because under a hire purchase, you are expected to be paying what? On instrumental basis. So what you pay on instrumental basis is what you are going to claim the capital allowance. But where it is not under an hire purchase agreement, it is expected that any asset that we qualify capital allowance must be what? Must be owned by the person making the claim. The asset must be in existence and in use as at the end of the year of assessment under review. It must be something that we can see that, yeah, truly, you have this asset. It must not be something that is imaginary. Something that, okay, you are claiming that, you are assuming that you want to buy that asset in the next 2 years. You have now included it in yours. So no, it's not. It must be what? Readily available and in existence before you can what? You can claim the capital allowance. It must be what? Rent for the purpose of the business or trade. What we mean by rent, W-R-E-N, it must be wholly, reasonably, necessarily, and exclusively used for the purpose of the business. It must be rent for the purpose of the business. It must be wholly, reasonably, exclusively, and necessarily used for the purpose of the business. If you are using it for personal purpose, it will not qualify for capital allowance claim. It must be used for the purpose of the business. There is also expected that a written application must be made to the relevant tax authority. You must write, because the tax authority, they don't know you. You are the one that will tell them that, okay, you have acquired this asset for the purpose of your business. That information must be given to the relevant tax authority for them to work upon. Then where the amount. So those are some of the conditions that are available for granting capital allowance. So if your non-current is able to satisfy any of these conditions, you'll be entitled to capital allowance claim. It is not compulsory to satisfy all the conditions, but satisfy some of the conditions that are stated as well. Condition for the granting of capital allowance. Any question? Any questions so far? Any question? Ask me question now, because we don't have the opportunity to ask the question any question. Can somebody respond? Okay. In the absence of no query, let us proceed further. Then also, under this capital allowance, we are going to be looking at what is called the basis period for capital allowance. 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 Because as a business entity, when you are doing a business, it's expected that you are not going to buy quiet at once. Or financial whatever that will depend on what, how you are going. So if the asset date, so that means we must know that capital allowance purpose. We must know the date. That's what the asset will start claiming. We start claim for capital allowance purpose. So in the first instance, is that we know what we call basis period. Under the basis period, we have talked about basis period for what? For accessible profit, which we look at under our commencement, cessation, and change of accounting date. For instance, assuming a business is commencing operation, any asset they now buy, how do we determine when to what? When to allocate that asset for the purpose of what? For the purpose of capital allowance. Please, because it has been stated that the Finance Act has eliminated the issue of what? Overlapping and gap in basis period. So when you are commencing operation or when you are ceasing operation, there is nothing like overlapping or gap in the basis period again. That does not mean that you may not still have a question that may still have what? Gap in what? In basis period. You may still come across a question that will still what? Have a gap. In a situation whereby what? A company, you are giving what? The three scenario. When you are giving a three scenario of what? Commencement, change of accounting date, and cessation together. It is possible that there is still going to be a gap in between the what? The basis period. So how do we now? So what now happen if the company now buy an asset between those gap? Please, for the purpose of computation of capital allowance, the basis period you have established for your accessible profit is also the same thing you are going to use for what? For the computation of capital allowance. Basis period established for what? For accessible profit, the basis period that you have stated that, okay, this is the basis period we are going to use to calculate our accessible profit. That is the one you are also going to use for the allocation of the asset. For instance, let's say you have a basis period. So let me use let me upload my Excel sheet so that I can use that to illustrate properly, that we can get a good understanding of what I'm saying. Okay. So I'm coming. Okay, what I'm just saying is, for instance, assuming my Excel sheet is coming up on a particular date, let's say they commence on 1/10, 1st of April 2020, and the accounting date is 31st December. That means the basis period relating to that particular company yeah, okay, yes. Yeah, yes, good. Assuming we have, let's say we have 2020, we have a tax year of 2020, and we have a basis period of 1/4/2020 to 31/12/2020. Let's say 29. Okay, let me use preceding. 2019 to 31/12/2019. Please, the implication of this is that any asset acquired in between this period of between April, any asset acquired by that business between April to December 2019 will be available for capital allowance computation in 2020 year of assessment. It's going to be available in 2020 year of assessment. Let's say they now buy motor vehicle on 5/8/2019. 5/8/2019. So this motor vehicle that was bought on 5/8/2019, this 2020 year of assessment. Why? Because of the basis period. This basis period fall in between the period that they acquired the asset, which is what 5/8/2020, fall in between what this stated basis period. So this asset now, this motor vehicle will now start claiming capital allowance from where? From year 2020. That is what that means. By our basis period for what? For capital allowance. As I stated earlier, please, it is possible when you are given a scenario having what the three scenario, a question having the three scenario, having commencement, cessation, and change of accounting, it is possible that we have a gap in between the basis period. What do we mean by gap? Let's look at this situation. Situations of gap. What we mean by this gap is, let's say, like we have 2020 now. So we have the basis period to be 1/1/2019 to 31/12/2019. Then we now have 2021. Instead of 2021 to start from the next date, you know, the next date is supposed to be 1/1/2020. It's now starting from 1/4/2020 to 31/12/2020. Please, this is a situation of a gap. You can see that a particular some months were omitted. That month that were omitted are called gap. Please, you can tell me what are the months that are omitted here? I need somebody to respond. What are the omitted months?
January to March.
January to March.
Yeah. Which year?
2020.
January to March. Yeah, January to March 2020. That's January to March 2020 now. Is what is called a gap. They call it a gap. So that means well, you cannot find it in between this basis period. So that period, there is a gap in between the basis period. When you have such situation, please, assuming this company, assuming they now
We can't hear you, sir. Your voice is breaking. Sir, we can't hear you.
Let's say the motor vehicle was now bought.
Your voice is breaking, sir. Thank you.
And the call is lagging.
2020.
We still can't hear you.
Now bought second
Thing is lagging.